Volatility is just basically the market's reaction to the uncertainty that's out there into the future, right? And the VIX is the way we capture that. We look at volatility in terms of the VIX Futures term structure and the cash. And what it's trying to do is capture the volatility that can be in the markets over the next 30 days, 60 days, 90 days. So that being said, if there's a lot of uncertainty out here, and frankly, you tell me. I mean, when we close the markets on Friday, are we worried that on Saturday or Sunday there's going to be some news about tariffs? Well, the last couple of weeks that's been the case. So now we have something more to worry about. And the more things we have to worry about, Conway, about the uncertainty, the more that volatility is going to start to rise. Now, remember, volatility is a two-way street here. It's not a bad thing. It's only a bad thing when people start selling into the down move. All volatility is that the market's going to move like this. If it's moving normally like this, higher volatility means it's going to move like this. It means that there's going to be bigger down days, but there's also going to be bigger up days. But, as an investor, I feel 6 to 10 times worse when the market's going down a lot than it is when the market's going up a lot. So that's going to cause me and a lot of other investors to go ahead and sell and fire my stocks before I have a chance to lose any more money. And usually that's the wrong way to go, wrong approach, right? Because when volatility is starting to spike, we want to be selling volatility. We want to be getting long the markets. When people are throwing the baby out with the bathwater, they want to get in there and they should be getting in there and start buying stocks. But, at this point in time, with volatility, it's actually fairly muted, Conway. It's a 15.5 right now, which you think that, it's expecting, the market is expecting about a 1% move in the markets over the next 30 days. And that's relatively normal, a little bit less than normal than we normally have.
So as you're keeping a close eye on the VIX, how can the average investor use volatility during Trump 2.0?
Well, I think, big spikes in volatility when we got them in late in January are good opportunities to jump in there and start buying stocks. I think you have to hold your nose and dismiss all of the things all the distractions that are coming around you. Things like tariffs or any other attacks, or talking about the Gulf of America, or we're going to pick up Gaza. All these little silly things that are going on that we have no control over. If they're affecting things in the markets, then we can take advantage of that opportunity, especially when the markets come down on a big spike in volatility. And I think those are the chances that we have to jump in there. I mean, when you talk names like Meta recently got hammered on some news that really was unrelated to them. It was an opportunity for you to pick up some of that stock, and now it's at or near all-time highs.
So in trader speak, we here at the New York Stock Exchange, you're telling people buy the dip.
Buy the dip, yeah, buy the dip.